Okay, in this chapter, we're going to discuss forecasting financial statements. Notice that the title of the chapter is Corporate Valuation and Financial Planning. It's really the financial planning part that we're focused on. At the end, we will take a little look at corporate valuation, but that's mostly a subject for Chapter 8. So we'll get to that next time. Now, recall that our ultimate goal in this section of the course is to determine the value of the firm. And in Chapters 6 and 7, we looked at the financial statements and tools that we could use to analyze them. So in Chapter 6, we looked at the income statement, the balance sheet, and the statement of cash flows. We also talked about things such as free cash flow, return on invested capital, and economic value added. And we'll use those things in this chapter as well. And in Chapter 7, we look at the financial ratios, and of course we're going to use those as well because we can use the financial ratios to help us to improve our financial statements and figure out what we need to do in the future. In this chapter, though, we're looking at mainly forecasting the financial statements, and we're also going to forecast free cash flow. That's important because the value of the firm, more specifically the value of the firm's operations, is the present value of all of the future free cash flows that are expected. Now, in order to forecast free cash flow, of course, we need to forecast the financial statements. So you'll recall that free cash flow is NOPAT minus the change in total operating capital. So we can calculate NOPAT from a forecasted income statement, and the operating capital can be calculated from a forecasted balance sheet. So we need both of these. Once we have our free cash flow estimates for the future, we can use those to find the value of the firm, and we'll see how to do that as we go through the chapter. Now, one last thing, realize that the forecasted financial statements are very often called the pro forma financial statements. Now, pro forma is a Latin term, and it really means as a matter of form, but for our purposes, we can interpret it to mean as if. In other words, the financial statements that we forecast will be presented as if the forecast period had already occurred. Okay, in the mini case, they give us a bunch of financial ratios for Hatfield Medical Supply and for the industry. And question A says, using Hatfield's data and its industry averages, how well run would you say Hatfield appears to be compared to other firms in the industry? And then also use the DuPont equation as one part of your analysis. So remember, in Chapter 7, we looked at financial ratios, and as a part of that, we did the DuPont equation. And remember, the DuPont equation breaks down the firm's return on equity into three pieces. So we'll do that here in a minute. But if you take a look at these financial ratios, you can see that Hatfield appears to be poorly run. Their costs are too high, their debt is too high, etc. So here are I'm calling them the lowlights. So operating costs are too high. So if you look at operating costs to sales, it's 90% versus the industry at 88%. Receivables, inventories, and fixed assets are also too high. So receivables is 14% of sales versus the industry at 11%. Inventory is 20% of sales versus the industry at 15%. And fixed assets are 25% of sales versus the industry at 23%. So if you go back to Chapter 7 and you look at the turnover ratios, the efficiency ratios, you'll see that these are basically the inverse of those ratios. Now, also note that debt is too high, and in this case we have total liabilities to total assets of 48.33% for Hatfield versus 36.7% for the industry. And return on invested capital, return on equity, and the net profit margin are all too low. So in other words, they're not as profitable as they should be. So you can see here that return on equity is 10.65%, but the industry is at 16.1%. And the net profit margin is 3.3% versus 4.99% for the industry. So the point here is that the firm is underperforming and therefore the market has undervalued the stock. Now, let's take a look at the DuPont equation. So I have down here at the bottom, I have the ROE broken down according to the DuPont equation for Hatfield Medical Supplies and also for the industry. So if we look at these three pieces individually and compare them to the industry, you can see why the Hatfield ROE is so much lower than the industry. First of all, the net profit margin is 3.3% versus almost 5% for the industry. Secondly, the total asset turnover ratio is 1.67 for Hatfield versus 2.04 for the industry. And then the only thing that Hatfield has going for it that is boosting its ROE is the fact that its equity multiplier is higher than the industry at 1.94 versus 1.58. Now remember, the equity multiplier is simply a measure of the amount of leverage that the firm uses. So Hatfield is using more leverage, and that's boosting its ROE. But profitability and using assets efficiently is hurting their ROE. Now let's talk a little bit about forecasting the financial statements, and more specifically, the income statement and balance sheet. And note, if you want to, once you have an income statement and balance sheet forecasted, of course you could forecast a statement of cash flows. We're not going to do that here, but it could be done. So the technique that we're going to use is something known as the percent of sales method. And the idea behind this method is that there are many items on the income statement and on the balance sheet that go up and down as sales goes up and down. In other words, they change in proportion to sales. And we can use that to forecast these items. And let's look at some examples. So here I'm showing Microsoft for the years 2015 to 2019. And you see sales and cost of goods sold. And then in the far right column, you can see cost of goods sold as a percentage of sales. Notice that it's always around 35, 36, 38%, something in that range. And so knowing that, and that the average percentage of sales for cost of goods sold is 36.41%, if we were to forecast Microsoft's cost of goods sold as about 36.5% of sales next year, we would probably be in the right ballpark. Now, note that the one thing that we need, and we will take as a given for this course, is a sales forecast. So somebody's going to hand you a sales forecast and ask you to forecast the income statement and the balance sheet. On the balance sheet, there are items as well that maintain a constant proportion of sales. So just as an example for Microsoft, here you see the accounts receivable and accounts receivable as a percentage of sales. And you notice that it's always around 20, 22, 24%, something in that range, and it averages a little over 22%. So if we wanted to forecast accounts receivable and we know a sales forecast, 22% of that would be a good guess at what accounts receivable is. So that's the basic idea behind the percent of sales method. There are some complications, as we'll see. All right, so we want to look at forecasting the 2019 income statement for Hatfield Medical Supplies. And we're going to make some assumptions. So we're going to assume that sales will grow by 10%. And in 2018, note that sales were 2,000. So that means that sales in 2019 will be 2,200. We're also going to assume that the operating ratios remain constant. Now, in this particular case, take note of the fact that all of the firm's assets are operating assets, and therefore everything on the income statement will change by the same 10% as sales. So they've made this simpler. In reality, though, you need to go item by item through the financial statements and ask yourself, do I believe that this item is going to grow at the same rate as sales? If so, you can use the percent of sales method on it. If not, then you need to use some other method of forecasting that item. And that could be as simple as just leaving it at last year's value, or it could be something like a regression analysis or some kind of complicated time series method. So here you see Hatfield's 2018 income statement, as well as the forecasted income statement for 2019. As I said a minute ago, sales will be $2,200, and then your operating costs are going to increase by 10% as well, from $1,800 to $1,980. Depreciation will rise from $50 to $55. Now, ordinarily, we would not increase depreciation like this because depreciation is a function of the amount and the age of the fixed assets. So normally we would not increase it, but because of the assumptions that they're making here, we're increasing depreciation by 10%. Notice that interest expense is a non-operating cost. So we're leaving interest expense where it was in 2018. It stays at 40. We have EBIT of 165, interest expense of 40. That gives us earnings before tax of 125. Taxes will be 40% of that, leaving us with net income of 75. And then you can see I've done some other calculations as well. So I'm assuming that the dividend goes up by 10%. The addition to retained earnings is simply net income, 75, minus the dividend of 22 gives us 53. That will go to the balance sheet. The shares outstanding are going to remain the same. And then earnings per share and dividends per share you can calculate based on the number of shares outstanding. For the balance sheet, we're going to do essentially the same thing. But again, it's more important, especially on the balance sheet, to go item by item. So for example, we're going to assume that all of the assets change at the same rate as sales, and that's because of the way that they've set up the assumptions in the mini case. And they've done that to simplify it. But in reality, you need to go item by item and ask yourself, do I think this is going to change along with sales? And it can be a good idea to look at that item as a percentage of sales over the past several years to see if that kind of an assumption makes sense. So just understand that for purposes of the mini case, this has been simplified. So let's look at assets. So in Part B, they tell us that the firm is operating at full capacity and that all ratios will remain the same as in 2018. Now, let me point out that this operating at full capacity assumption is a code word that's very often used in textbooks to suggest that your fixed assets will increase at the same rate as sales. Now, in most cases, that's not a good assumption because if a firm expects sales to rise by 10%, they don't go out and acquire 10% more fixed assets. Instead, when they buy fixed assets, they will usually buy more than they're going to need for the next several years. That way, they're not constantly acquiring new fixed assets. So it's more efficient usually to buy them all at once for the next several years and then grow into it over time. Nonetheless, as I mentioned, everything on the asset side is going to go up at the same rate as sales. So you notice that cash goes up by 10%. And I'll point out that normally that's also a bad assumption because firms have much better things to do with their cash rather than just hoard it. So normally cash and sales have a very low correlation with each other. So it's not uncommon to see a firm's sales rise but their cash balance go down. But in this case, we're assuming cash goes up right along with all the other assets. Accounts receivable and inventory usually do fluctuate directly with sales. So it's probably a good assumption to assume that they will go up by 10%. And then I already mentioned that net fixed assets, usually you probably would leave that unchanged or make some minor adjustments to it based on some other information that you have, not based on the percentage of sales. Now, when we get to the liabilities and equity side of the balance sheet, we have a couple of other things going on. And specifically, there are two kinds of financing. So previously, we've talked about current liabilities, long-term debt, and equity. Well, now we're going to break that into two different kinds of financing. The first one is spontaneous sources of funds. These are sources of funds that increase automatically with sales. In other words, accounts payable and accruals. And you can pretty well count on the fact that you're going to see this increase or decrease right along with sales. Spontaneously, right? So it's not like the firm makes a decision to go out and get some more accounts payable. It just automatically happens as sales goes up. Discretionary sources require a decision by management. In other words, management has to use their discretion to choose when and how to raise this kind of funding. So this would be your notes payable, your long-term debt, and your equity. Now, let me point out, when it comes to equity, I'm talking here about selling new common stock. The other source of equity that a firm has is retained earnings. So in 2018, the firm generated some net income. Out of that, they paid some dividends, and the rest they retained. That retained earnings, that change in retained earnings, is available for investment purposes in 2019. So when it comes to equity, retained earnings, you can think of it as spontaneous, and new common stock can be thought of as a discretionary source of financing. So the spontaneous sources go up at the same rate as sales, but with discretionary sources, we leave them at last year's value, because later on, we're going to figure out how much to add to notes payable, long-term debt, and new common stock. So with accounts payable and accruals, we increase them by 10% to 88. Long-term debt stays the same. Common stock stays the same. And then retained earnings goes up by 53 because that was net income minus dividends. Now, when we total up the liabilities and equity side of the balance sheet, we get 1,261, and our total assets are 1,320. So remember that the balance sheet has to balance. That's why it's named a balance sheet. And in our forecast, it doesn't balance. There's a good reason for that. And the reason is that we want to know how much discretionary financing we need to go out and raise. And that will be the amount that brings the balance sheet into balance. And we call this AFN, which stands for additional financing needed. And in this case, you can see that AFN is 59. So if we add 59 to the 1261, we get 1320, and that would make the balance sheet balance. Now, that 59 that we need in discretionary financing, or what we call AFN, has to be raised in some way in order to support the level of sales that the firm expects. So remember that every dollar of assets has to be financed either with debt or equity. And in order to support a certain level of sales, you need a certain level of assets. So we're forecasting that the firm needs 1,320 in assets. And in order to have that amount of financing, they need to go out and raise an additional 59. That's what AFN is. Now, imagine that they raise this money by issuing some kind of debt. So if they do this, then that will not only increase debt, but it would normally increase interest expense. And if you increase interest expense on the income statement, that's going to reduce your net income, which would reduce your retained earnings, which means your balance sheet is going to be out of balance again. And so after you've done that one time, you again have some amount of AFN. However, it will be smaller. And each time you go through this loop, so you add more debt, which increases interest expense, which reduces net income, which reduces retained earnings, leaving you with still a smaller AFN. Eventually, you're going to get down to where AFN is 0. And you can add up the total amount that you've added to the balance sheet to make it balance, and that's your total AFN. All right, so what if, instead of using debt, what if they issued new equity to raise this 59? Well, in that case, they're going to have to pay more in dividends. More shares equals more dividends. And remember that the change in retained earnings is net income minus dividends. So if the dividend gets bigger, the change in retained earnings gets smaller, and your balance sheet will be out of balance again. But just like before, what you would do is you would issue a little bit more common stock, increasing the dividend and reducing retained earnings, and then do it again and again and again. But eventually, you'll get to where the AFN is 0, and the total of all of those steps will give you the total AFN. This is called a financing feedback loop. So however the firm decides to raise this money, they're going to have to go through this financing feedback loop several times and figure out what the total amount is that needs to be added to the income statement. Now, as we'll see here in just a second, in the mini case, they're going to skirt around this issue by assuming that there's no interest paid during 2019. So in Part F, in the mini case, they say if the operating results and preliminary financing plan cause a financing deficit, eliminate the deficit by drawing on a line of credit. So let me explain here. If AFN is a positive number, and remember how we calculate AFN is it is total forecasted assets minus total forecasted liabilities and equity. So if that number is positive, which it is in this case, we saw it was 59, that means there is a deficit of discretionary financing. And in this case, they would draw on a line of credit, and that line of credit, they say, would be tapped on the last day of the year, so it would create no additional interest expense for this year, 2019. Because of that assumption, we get around this idea of the financing feedback loop that we talked about previously. So adding debt, in this case, is not going to increase interest expense until 2020. But we're not forecasting 2020 at this point, so we don't need to worry about it. Then they say if there's a financing surplus, that would mean your AFN is negative. Eliminate it by paying a special dividend. So a surplus would mean they have more financing forecasted than what they need. And so one of the things they could do to get rid of that extra financing is to pay it out as a dividend. They could also pay off debt, or they could invest it in some kind of non-operating asset, such as short-term investments. Now it says after forecasting the 2019 financial statements, which we've done, answer the following questions. How much will Hatfield need to draw on the line of credit? Well, we saw that. That was 59. That's our AFN. And what are some alternative ways, other than those in the preliminary financial policy, that Hatfield might choose to eliminate the financing deficit? Well, they could issue debt, which is what they're going to do. They're going to tap a line of credit, that's debt, or they could issue new common stock, or maybe they choose to grow more slowly. Rather than estimating a 10% growth rate, maybe they only estimate a 5% growth rate, and that might or might not eliminate this AFN. So they have a number of alternatives that they might choose, but what they've told us here is that they're going to tap a line of credit. So here you see the forecasted 2019 balance sheet, which is what we saw earlier, right? So we have forecasted total assets of $1320 and forecasted total liabilities and equity of $1261. That gives us AFN of 59. What we're going to do is tap this line of credit for 59, and that will go into notes payable. And if we add that 59 into notes payable, you can see in the final column there, that will bring our balance sheet into balance. Now, again, ordinarily, this additional notes payable would increase interest expense, but because of the way that they've set this up, that's not going to happen until 2020. Now, we can also look at additional financing needed in a little bit different way. The way that I just showed you is the way that it generally should be done. But we can also estimate additional financing needed using an equation. Now, let me point out that this equation is not really a good way to do this because it assumes that a bunch of ratios stay constant, which they rarely do. So at best, this is a quick and dirty estimate of what AFN will be. It also, though, gives us a way to think about AFN. So if we take certain actions, what effect would that have on the AFN? And the equation is useful for that, more useful than it is for actually estimating AFN. So assuming that all of the ratios remain constant, which as I said is not really a good assumption, we can calculate AFN with the following formula. And you can see the formula here, and I'm going to explain this piece by piece. It looks complicated, but it's not really. So A star in the first term is the amount of assets that will change right along with sales. And in this mini case, that is all of the assets. So if we take those assets divided by sales and multiply by the change in sales, that tells us how much we're going to need in additional assets. And remember, for every dollar in additional assets, we need an additional dollar of financing. Now, some of that financing will be spontaneous sources of financing, and that's what we have next. So L star is your spontaneous liabilities. In this case, that's accounts payable and accruals. So spontaneous liabilities divided by sales times the change in sales tells us how much we're going to have in spontaneous liabilities. In other words, automatic financing. And then the last term is the expected sales for next year, that's S1, times the net profit margin, that gives us the forecasted net income, times 1 minus the payout ratio, gives us, that third term gives us the change in retained earnings, which is spontaneous equity financing. So really, the way to look at this is that AFN is simply the total financing needed minus your spontaneous liabilities minus your change in retained earnings. Now, in Part B, in the mini case, they say use the AFN equation to estimate Hatfield's required new external capital for 2019 if the sales growth rate is 10%. Assume that the 2018 ratios will remain the same in 2019. So using this equation, what we have here is our assets divided by sales, 1,200 divided by 2,000, times the change in sales. Remember that our estimate for sales next year is 2,200, so the change in sales is 200, minus the additional spontaneous liabilities that we're going to have. That's 80 divided by 2,000 times 200, and then minus the additional retained earnings that we're going to have, which is the 2,200 times 3.3% times 1 minus 30.3%. Now, let me point out that this 30.3% payout ratio, it looks almost the same as the net profit margin, which is 3.3%. That's purely a coincidence. Don't read anything into that. So what we get for our estimated AFN is 61.3978. Now, below that, I've done the calculations. So we need 120 in additional financing. We're going to have 8 in spontaneous sources of funds, or spontaneous liabilities, and we're going to have 50.6022 in additional retained earnings. So 120 minus 8 minus 50.6022 gives us 61.3978. Now, in Part C, the mini case says, define the term capital intensity and explain how a decline in capital intensity would affect AFN. Well, I've put the AFN equation off to the right here, and the first fraction there, the assets divided by sales, is capital intensity. So capital intensity is just how many dollars in assets do you need per dollar of sales. So if capital intensity rises, if for some reason they become less efficient and they need more assets for each dollar of sales, that would increase the AFN. If, on the other hand, they become more efficient so that they can create their sales with fewer assets, then that would reduce the AFN. Again, that's all other things being constant. Now, also from Part C, they ask, would economies of scale combined with rapid growth affect capital intensity, other things held constant? Well, let's think about this. So economies of scale means doing more with less, right? So as a company gets bigger, very often they become more efficient, and that means that their capital intensity would decline, and that would reduce AFN, all other things being equal. But companies that are growing rapidly often cannot get more efficient, and in fact, they sometimes get less efficient, and therefore they're going to need a lot of new assets to support the new sales, and their AFN may rise. So when you combine these two things together, it's difficult to know which one is going to win out. Are they going to become more efficient, or is the rapid growth going to overwhelm any changes in efficiency and cause them to need new assets? It could go either way. Now, also from Part C, they say, explain how changes in each of the following would affect AFN, holding other things constant. This is where I think this equation has some merit, because we can think about, for example, what if we grow more quickly? What effect would that likely have on AFN? Or what if the amount of accounts payable increases? What effect would that have on AFN? And that's exactly what this question is asking. So let's look at these in turn. So if the growth rate increases, that's going to increase delta S, that's the change in sales, and it's also going to increase our sales for next year. The key here to understanding this is that assets as a percentage of sales, that capital intensity, is bigger than the liabilities as a percentage of sales or the change in retained earnings. So the growth is going to increase the amount of assets needed more than it's going to increase the spontaneous liabilities or the retained earnings. So if the growth rate goes up, we would expect that AFN would rise. Now, the second one asks about the amount of accounts payable. So accounts payable is a spontaneous source of financing. So that second term is going to get larger. Everything else stays the same, and that means that if accounts payable goes up, AFN would decline. And notice that I've made a mistake here. This should say if accounts payable rises, AFN will fall. So I'll fix that in the PowerPoint notes. And then it also asks about the profit margin. Well, if the profit margin increases, that's going to increase the amount of retained earnings available. So if the profit margin goes up, they're going to have more financing from equity, and the AFN should fall. And then finally, they ask about the payout ratio. Well, again, the payout ratio is going to affect the change in retained earnings. So if the payout ratio rises, that's going to leave less in retained earnings, and your AFN would rise. So in my opinion, this is really the only truly legitimate use of this equation, is to think through how changing one thing would affect the AFN. Now, we can also use that AFN equation to calculate something called the self-supporting growth rate. And what this is the maximum growth rate of sales that does not require any additional external financing. In other words, how fast can they grow without having to tap the capital markets? So if we rewrite the AFN equation so that it includes the growth rate of sales, all we're doing here in these first two terms is we're replacing the change in sales with the growth rate times sales. It's exactly the same. It's just that we have that G in there. And then for the change in retained earnings, instead of using S1, we take S0 times 1 plus the growth rate. So now all we have to do is set this equal to 0 and solve for that growth rate. And so here you can see the equation. And what this simplifies down to is the change in retained earnings divided by the new assets minus the spontaneous sources of financing, which includes your spontaneous liabilities and your change in retained earnings. So it looks more complicated than it is. Now let's plug some numbers into this. And so you see that we have sales in period 0, 2018, is 2,000 times the net profit margin times 1 minus the payout rate divided by our spontaneous assets, which is 1,200, minus our spontaneous liabilities, which is 80, minus, again, the change in retained earnings, gives us 4.283%. So in other words, Hatfield should be able to grow at 4.283% without needing any external financing. Okay, now recall that our goal for this section of the course is to estimate the value of the firm. And in order to do that, we need to be able to forecast the future free cash flows. And we can get those by forecasting the financial statements. Now, Part E of the mini case says use the following assumptions to answer these questions. First of all, operating ratios remain unchanged. Second, sales will grow by 10% next year, 8% the year after that, 5% the year after that, and then 5% the year after that. The cost of capital is 9%, and then they're calling this the no change scenario. And they want us to estimate for the next 4 years sales, cash, accounts receivable, and so on, a bunch of things. So basically, all of these things are going to grow at the same rate as sales. So it's pretty straightforward to do this, although I will admit if you're doing it by hand, it's tedious. This is where spreadsheets really come into their own. And so if we look at sales, it starts at 2,000 in 2018. Then it grows by 10% to 2,200. In 2020, it grows by another 8% to 2,376. In 2021, it grows by 5% to 2,494.8. And then in 2022, it grows to another 5% to 2,619.54. So all we're doing is we take the previous sales times 1 plus whatever the growth rate is. And then we're going to do the same thing for cash and accounts receivable and inventories and net fixed assets and accounts payable and so on. So here you can see all of those forecasts. Now, this is enough information for us to be able to calculate free cash flow. And so also from Part E, they say using the previously forecasted items, which you see on the screen, calculate for each of the next 4 years the net operating profit after tax, that's NOPAT, net operating working capital, total operating capital, free cash flow, and the annual growth rate in free cash flow, and the return on invested capital, ROIC. Okay? So first, let's take a look at NOPAT. So NOPAT, remember, is simply EBIT times 1 minus the tax rate. So we know what sales are going to be. We know what our operating costs are going to be. We know what depreciation is going to be. So sales minus operating costs minus depreciation gives us EBIT. And if we multiply that by 1 minus the tax rate, we get NOPAT. Now, remember that all of those items that I just mentioned are growing at the same rate as sales. That means that NOPAT will also grow at the same rate as sales. So you could calculate NOPAT for each year, and I suggest that you do that just to get practice. Or once you've calculated it for 2018, then you can just grow it by applying the growth rates. So in 2019, NOPAT gets 10% bigger. In 2020, it gets 8% bigger than it was in 2019, and so on. Now, net operating working capital is going to be your operating current assets, which is accounts receivable and inventories, minus your operating current liabilities, which is accounts payable and accruals. I think I don't have it listed in the table, but that was part of the accounts payable. So for 2018, net operating working capital would be 680 plus cash. I forgot cash, so plus 20, that's 700, minus 80, which is accounts payable, gives you 620. Now again, each of those items grows at the same rate as sales, so net operating working capital must also grow at the same rate as sales, so you should be able to forecast that out. Now your total operating capital will be your net operating working capital plus your net fixed assets. So we already calculated in 2018 that net operating working capital would be 620, and if we add the net fixed assets of 500 to that, we get 1120. And again, that's going to grow at the same rate as sales. Now, we want to calculate free cash flow for each year. So free cash flow, remember, is NOPAT minus the change in total operating capital. So for 2019, NOPAT will be 99, and the change in total operating capital will be 112. So 99 minus 112 gives us negative 13. In 2020, NOPAT will be 106.92, and the change in total operating capital will be about 98. And so 106.92 minus about 98 gives us 8.36, and so on. So you could do each year. The growth rate of free cash flow, you can see here, we cannot calculate a growth rate of free cash flow for 2020 because it starts out negative, and a growth rate from a negative starting point doesn't make any sense. But you can see that in 2021, free cash flow goes from 836 to 4574, so that's a 447% growth. And then in 2022, it goes from 4574 to 4802, which is 5% growth. And then finally, they ask us to calculate the return on invested capital. Well, remember that return on invested capital is NOPAT divided by total operating capital. So for each year, we have NOPAT and we have net operating working capital. Remember that both of those are growing at the same rate as sales. And because of that, since the numerator and the denominator grow at the same rate, the ratio, return on invested capital, will stay constant. And it turns out that it's 8.04% each year. Now, the next part of the question says, what does the forecasted free cash flow in the first year imply about the need for external financing? Well, it implies, because free cash flow in 2019 is expected to be negative, that implies that they're going to need some external financing in 2019. We've already seen that that's in fact the case. And then it says compare the forecasted return on invested capital with the cost of capital. Well, the cost of capital, if you'll recall, was 9%. So that 9% is the required return for the firm. The return on invested capital is their actual return. So they're going to earn 8%, but they're required to earn 9%. So that means that the company is destroying value. They need to fix some of those problems that we talked about at the very beginning in order to get the return on invested capital above the weighted average cost of capital. So right now, they are destroying value. This is not good. This is why the company is undervalued relative to its peers. Okay, now we've forecasted the firm's free cash flows. And so what we want to do next is we want to use those free cash flows to value the firm's operations. Now, in Chapter 8, we're going to go into this in much more detail. But for this chapter, we'll just do a kind of a quick run through. So the value of the firm, as I've mentioned earlier, is the present value of all of the firm's free cash flows from now till infinity. So we can write that mathematically as follows. So all this says is that you take the free cash flow that you're forecasting for each year, find the present value, and then add them all together. The problem is that the value of the firm is the present value of all of the future free cash flows forever, not just for the next few years. And we've only forecasted the next 4 years worth of free cash flows. So we have to figure out some way to find the value of everything after that 4th year. So what do we do about the free cash flows after that? Well, generally what we do is we assume that free cash flows are going to grow at a constant rate. And you should be familiar with the constant growth model, which we usually use with dividends, but it really is just a general formula that we can use for free cash flows or any other cash flow that's growing at a constant rate forever. And so here is that formula. And so you can see what we're going to do is we're simply going to find the future free cash flows in 2023 and divide that by the cost of capital minus the growth rate. Now, we know the free cash flows that we're forecasting for 2022, so we can simply take that times 1 plus the growth rate, which I believe is 5%, and then divide that by the cost of capital minus the growth rate. This will give us something that we call the horizon value. That is, what is the value out there at some point in the future? And in this case, that point in the future would be 2022, which is the last period that we have forecast the free cash flows for. So we have the present value of the next 4 free cash flows plus the present value of that horizon value, and that will give us the value of operations in 2018. So let's go through this step by step. So the first step is we know that we're forecasting free cash flow to be 4802 in 2022, but what we need for our constant growth model is the free cash flow in 2023. So that would be 4802 times 1.05, because it's 5% growth rate, gives us 50.43. Second step is to plug that 5043 into the constant growth model. And so here you can see that. So it's going to be the, oops, I've screwed up my little equation here. It should be 4802 times 1.05 divided by 0.09 minus 0.05. And that will give us the 1260.65. Now, what the 1260 is, that's the present value of the free cash flow in 2023, and the free cash flow in 2024, and the free cash flow in 2025, and so on out to infinity. So that's the present value as of 2022 of all of the free cash flows from 2023 out to infinity. So you can see on the timeline here, what we have for our cash flows is negative 13 in 2019, 836 in 2020, 4574 in 2021, and then in 2022 we have our free cash flow of 4802, plus we also have the horizon value. So the next step is to find the present value of those cash flows. And here you can see the math. So we're simply going to discount each of them at 9% per year for however many years, add them all together, and that gives us a value of operations of 957.53. Now, as I said, we're going to do this more in Chapter 8, so we'll break it down with a different example at that point in time. But the mini case in Chapter 9 asked you to do this, so I thought I would walk you through this. The mini case also asked you to do a different scenario, and I'm not going to walk through that because it's the same thing. You just change some assumptions and generate new free cash flows, and from the new free cash flows you get a different value. So you should be able to work through that yourself at this point. Okay, so that should do it then for the lecture material in Chapter 9. I'm going to take a quick look at the spreadsheet for the mini case next. I hope that you found this to be useful. Okay, what you see here is the spreadsheet that I've put together for the mini case in Chapter 9. And I'm not going to spend a lot of time on this because we went through all of this in the lecture. But up here at the top, you can see we have the DuPont analysis that they asked us to do when we were looking at the ratios. And speaking of the ratios, they are in the worksheet called Ratios, naturally. And this is just mainly the data that was given to us. There may be a few calculations in here. So we've done the DuPont analysis, and then below that, I have several calculations. So we have the AFN from the equation, we have the self-supporting growth rate, we have the AFN from the actual forecasted financial statements that we did, and then we have free cash flow, return on invested capital, and return on equity. Now notice these red triangles that you see on some of these, for example, the self-supporting growth rate. These are just comments that I've left that hopefully make it a little bit easier for you to understand what's going on if you look at the spreadsheet. Now, off to the right, you see all of the forecasts that we did in Part E. So remember, they asked us to calculate all the future sales and the future cash and the future accounts receivable and so on. So that's these calculations here. And then below that, you can see where we calculated NOPAT, net operating working capital, total operating capital, and free cash flow, and the return on invested capital. And then below that, you can see where I've calculated the horizon value. That's at 2022. That's what the company would be worth at that point in time. And then right below that, where it says value of ops, that's the value of operations at the end of 2018. So that's the present value of all the future free cash flows. Now, also, I have in here, I have the pro forma income statement and the pro forma balance sheet. And one thing that I want you to note here is that in Part G, they ask you to do this alternative scenario. So I have a little drop down here. You can drop this down and choose Part G, and you can see what happens. So if I go back to normal, net income was 75, and with the assumptions in Part G, it jumps up to 84.24. And in the pro forma balance sheet, the interesting thing is that in Part G, now AFN is a negative number. Remember, that represents a surplus of financing. So they have more financing than they actually need. And in this particular case, what we're going to do is we are going to pay a special dividend in that amount. I think that's probably enough for the mini case spreadsheet. I hope that you found this to be useful.